to prepare and write a paper. Ruchita, you did not send me your documents. I need to fasten up the process.
Yeah, sir. I'll be sending.
Aadhaar
I'll
card
just
is
take.
done.
Have to take
You will
the
be
picture.
sending this week.
No, sir. Evening by evening. I'll go home and
Acha,
send,
acha.
sir.
Please send it so immediately I can do it. Yeah. And Nikhil, yours also, if you can fasten the process with Ruchita only, like things can be done, na?
Yeah, sir. I'll send you the documents in the morning.
Yeah, today itself you do it, please. So both of you, yours and Ruchita's, I will send the things and ask him to do soon. Okay.
Yeah. Okay.
Okay, okay, Nikhil. Just a second, let the recording thing start. Yeah. So as we have already started with the leases in the previous session, we have gone through the introduction. Now today we will do some examples and understand how to identify a particular contract or agreement as a lease agreement or a lease contract. Okay. So to identify a lease, these are the prerequisites or these are the conditions to be satisfied. Let's see what are the conditions, and in the next coming questions, you yourself should tell me whether it's a lease or not. See. So identifying a lease examples. So this flow chart would make your task more easier. First thing is there an identified asset? First of all, there should be an asset for which agreement is happening to use it for a longer period of time. That means lessor and lessee are making an agreement, and as per that agreement, this guy will transfer the asset to him, and he will not transfer the ownership rights, but lessee would get right of use of that particular asset. Okay, so the substance in the agreement is nothing but the asset which is to be leased out. Okay, so is there an identified asset which has to be leased out which has to be leased out to the lessee by the lessor? If it is yes, move forward. If it is no, stop there. It is, then we can say there is no leasing agreement or there is no lease at all. Okay. If yes, then next thing what you need to check is, does the customer have the right to obtain substantially all of the economic benefits from the use of the asset throughout the period of use? Yes. If yes, move forward. If no, no lease. Because economic benefits, who would be deriving the economic benefits from the asset usage? The lessee. Does the customer and the supplier or neither party have the right to direct how and for what purpose the asset is used throughout the period of use? So what is that? Does the customer, the supplier, or neither party, either customer or supplier, neither party have the right to direct how and for what purpose the asset is used? Yes, the customer would be using the asset for his purposes. The supplier or the lessor has no right to say him for what purpose the asset should be used. If it is then so here neither how and for what purpose the asset will be used is predetermined. That is what it is there in the agreement itself. The lessee says to the lessor for what purpose he is taking the asset. Okay. If yes, then move forward. Does the customer have right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions? If it's yes, move forward. Yeah, customer has right to operate the asset throughout the period of use. Okay, if yes, see here it is yes, yes, and this is the customer. Okay, So the customer, of course, will operate the asset throughout the period of use, or throughout the lease agreement, without supplier having the right to change those operating instructions. No. If it is no, then move forward. Did the customer design the asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use? Yes, he does that. And if it's no, then it is not a contract of lease. If it is yes, then it's a contract of lease. So the important points what I can say is right of use of asset is with the lessee. Asset should be there as a substance in the agreement between lessor and lessee. Lessee will derive the economic benefits out of the asset. He will use the asset for his own purpose, and he already agreed in the agreement for what purpose he is going to use the asset. Okay, so all these things would say whether there's a lease or not. If all these things satisfy, it's a lease agreement. If not, then no lease. Now there's a question in front of you, and you should tell me whether this is a lease or not. Please, all of you, please go through this question, and all the conditions what we have discussed should satisfy. Then again, if it is not satisfied, it is not a lease. Now all of you go through this, and Nikhil will answer the question to me whether it's a lease or not. Come on. Nikhil, are you going through?
Yes, sir. I'm going.
Yeah. So let me discuss with you. Coketown Council has entered into a 5-year contract with Carefleet Company. So they have entered into a contract. There's a contract under which Carefleet Company supplies council with 10 vehicles, it seems. So Carefleet Company will supply the council with 10 vehicles for the purpose of community transport. Carefleet Company owns the relevant vehicle. So Carefleet is the owner, it seems. And the right of use of asset is with the Coketown Council. You'll come to know that. All 10 of which are specified in the contract. So they own it. Coketown Council determines the routes taken for community transport and the charges and eligibility for discount. See, Carefleet is not going to decide how the Coketown will use the asset. They themselves know that for what purpose they are taking. Okay, the council can choose to use the vehicles for purposes other than community transport. When the vehicles are not being used, they are kept at council's office and cannot be retrieved by Carefleet unless Coketown Council defaults on payment. Of course, if they make the lease payment, then Carefleet has no right to take the vehicle from them. If the vehicle needs to be serviced or repaired, Carefleet is obliged to provide a temporary replacement vehicle of same type. So this is kind of operating lease kind of, but you know, we don't have a terminology of operating or finance lease in IFRS. As per the IFRS 16, there is only like we definitely have to see whether it's a lease or not operating or finance. That was there in the previous accounting standard. Now in the reporting standard, they have made some amendments. And yes, this is a lease. Why? There is the identifiable asset, the 10 vehicles. The council has right to use the vehicles for a period of contract, of course, not for the entire lifetime. See here, there was a paragraph now.
For 5 years, they are using those vehicles.
Yeah, here when we were saying throughout the period of use, no, it is till for the lease term only. After that, they have to give back. Yeah, right to like yeah, and also if anything is happening to the vehicle, the care fleet is giving them some replacement vehicle. So definitely it's a lease and shown in the and should be shown in the statement of financial position as a liability, lease liability, and lease asset. Okay. So first one is done, Nikhil. Second one, Abhigna, and then next one question more left over for Ruchita also. Come on. No, I will give a tough one to Abhigna. Simple one to Ruchita. Okay, you yourself can decide. There's no bias. Come on, who will take this second question?
I'll take
I will in the sense, who is that I?
Abhigna.
Okay, Abhigna. Go ahead. Yeah. So question is clear. Yeah, you can tell me.
Sir, the first step, it it has to be
Yes, yes,
identified,
please.
sir. But here there is no
Yeah,
asset.
so Broketown
There's
Council
service.
has recently made substantial cuts to its community transport service. It will now provide such services only in case of great need, assessed on case by case basis. It has entered into tour contract with Fleet Car Company for use of one of its minibuses for this purpose. The minibus must seat 10 people, but the Fleet Car Company can use any of its 10-seater minibuses when required. So they have
Yes.
not specified any asset now.
Yes, sir.
Any of the buses they
Okay.
can use. So we can't say it's a lease agreement. Done?
Yes, sir.
Yes.
Yes, sir.
Only they'll be making some rental payments, it seems, and they'll show in the P&L account as an expense, transport expense or whatever. And the next one, Ruchita, you should tell me what's the answer. And all of you, three of you can go through this and simultaneously do. Waiting.
Yes.
Yeah, yeah, yeah.
Sir, it is a lease as there is an identifiable asset and also a contract between the two parties.
Sorry, Ruchita, sorry. Extremely sorry. Yeah, again, come again.
So it's a lease agreement, sir, as there is an identifiable asset and also the contract between the parties.
Yeah, yeah. So like this is what the cabal enters into a 10-year contract with a utilities company for the use of for the right to use three specified physically distinct dark fibers within a large cable connecting north-south. Yeah, there's the asset. Cabal makes the decisions about the use of the fibers by connecting each end of the fibers to its electronic equipment. Yeah. So of course, the first thing is contract contains a lease of dark fibers, right to use asset of three dark fibers for 10 years. The term is also lease term is also there. Okay. And they would be using it. There are three identified fibers. The fibers are explicitly specified in contract and physically distinct from other fibers within the cable. So telling you cannot substitute the fibers other than for reasons for repairs, maintenance, or malfunction. Of course, that facility also they are giving, like the first question. Cabal has right to control the use of fibers throughout the 10-year period of use because see all those things are given, but actually for us what is important, it's a lease, correct? So now
Yes,
the
sir.
next topic what we are discussing is how to measure the right of use asset, because in the coming question you have to calculate right of use asset. Okay. So that is nothing but you are going to show in the asset side of balance sheet, that is lease asset and also lease liability. So we are speaking about lease asset now. So to calculate that, you should first find out the lease liability amount. So amount of initial measurement of lease liability. How will you calculate the lease liability? Present value of lease liability. Of course, some lease rental you would be paying every year, correct? So the lease rental have to be paid for 10 years, for example. It's a 10-year lease. So every year, whatever the amount you're paying is a current liability for you. Am I right or wrong? Please tell me.
Yes, sir.
See, the whole lease, the whole amount of lease liability is a long-term liability. But current portion of that long-term liability is a current liability. If this year your payment is 50,000 and the whole payment is 6 lakhs, so 6 lakhs is some lease liability. 50,000 happens to be current liability, na? Correct or wrong? I'm not asking correct or
Yes,
wrong,
sir.
sorry. I'm saying it is correct. Okay, you follow it. So the 50,000 every year, whatever the lease payments you would be doing, you would be finding out the present value of that at some, by discounting them with some implicit rate in the lease. If not implicit rate, then incremental borrowing rate. We already discussed in the first class. I'm sorry, Ruchita and Nikhil were not there, but you can follow up that. Okay. Now, initial measurement of lease liability is nothing but present value of the payments, lease payments, which you would be doing in the future. Now, apart from that, now I'm writing here, right of use asset. If you want to calculate, then present value of lease payments or liability plus, excuse me. Yeah. So that is there, and then you would be also, like, next thing what you would be adding is any lease payments made before the commencement date, less any lease incentives received. Suppose you are making some lease payments when you are commencing the lease, that you need to add. Lease incentives you need to subtract. See, lease incentive is nothing but you are going to become a lessee for a particular lessor. That lessor's business is to lease property. So every salesman wants to give some good benefit to their customers, correct? So he would be giving you some discount. He will be saying one lease payment I am giving you as a discount, or some you pay me some 50% of the first month, like that. Some incentives he'll give, you have to deduct. Any direct initial direct cost incurred by the lessee. So any cost you are incurring, you should add direct cost. And any cost which the lessee will incur for dismantling, removing, yeah, that cost also he need to add, dismantling or removing cost. So this is nothing but the calculation of lease asset, okay, right of use asset, okay. While doing a question right now, you will understand with the data. I'll show you. But first, please try to see this, what I'm explaining, and try to make a note of this.
Sir, what is the last one which you are adding to the lease?
Dismantling cost, dismantling cost or removal cost. Because all this you will be capitalizing with the asset now. Initially you are doing this, so they have to be capitalized.
Yes, sir. Yeah.
Yeah. Now lease liability, as I have already explained you, present value of future lease payment. So At the commencement date, the lease liability is measured at the present value of future lease payments, including any expected payments at the end of lease. This is important point. So any end payment at the end of, suppose you are doing a lump sum payment, so that you need to discounted at the interest rate implicit in the lease, or if not there, then lessee's incremental borrowing rate. So give a reading to this, we'll move forward. Okay. Now initial measurement part we have done. Next comes the subsequent measurement. Okay. Now what is this subsequent measurement? Subsequent measurement of the right of use asset after the commencement date. The right of use asset, that means commencement date of lease, the right of use asset should be measured using the cost model in IAS 16, International Accounting Standards 16, that is property, plant and equipment. So as you have recognized your asset, that means you have measured your asset initially. Now in the coming years, you have to do subsequent measurement. It will be similar to property, plant and equipment treatment. You will be depreciating your asset on every year basis, correct? Unless it is an investment property. So do you think investment property have to be depreciated? Please tell me. I have a question for you. Does investment property have to be depreciated? Please answer.
Yes, sir.
No, because their revaluation model is not a fair market value model you're using. That means every year you will be checking whether your assets value is increasing or decreasing yearly basis. It's unlike the property, plant and equipment. Okay, fine.
Okay.
If it's a tangible asset, it has to be depreciated. But when you specifically use it as an investment property, no depreciation. Just a second. There are different rules for that actually under IFRS, because we haven't come across it about the investment property. So IAS 40 deals with this, and as like just a second. Yeah, the do you depreciate? Actually, there are two things here, property, property, if you measure at fair market value, no depreciation is required. Okay. If it is not at fair market value, it is at cost model, it has to be it has to be depreciated. So let's go for the investment property and again kind of brush up. Do a small brush up for that. Yeah. So now see, the investment property should be measured initially at cost. And like IAS 40 requires an entity to choose two models, fair value, cost. If you are using fair value model, no depreciation is required. For cost model, depreciation is required. Okay. See, after initial recognition, an entity that chooses fair value model should measure all of its investment property at fair value. And gain or loss they should show in the P&L. Yeah, that's okay. Because fair market value is nothing but depending upon the situation in the market, you are going to value your asset. So it can go up or down. Okay, so there is no point of view like depreciating that asset, and depreciation is not required. But in case of cost model, assets held by lessees as right of use assets are measured at cost in accordance with IFRS 16. Investment property should be measured at depreciated cost less any accumulated impairment losses. So for which model? Please tell me.
Cost model.
Cost model. If you
Cost
are using
model.
a fair market value model, is depreciation
No
required?
depreciation.
No
No, sir.
No
depreciation.
depreciation.
Good, good, good.
Sir,
Yes.
but in that
Because
fair value model, like there is lines like in some cases.
uh-huh.
So can you scroll up once, sir, to the fair
Why not?
value?
Yes, yes, yes. See, you leave the part of land. Land is not at all a part of anything because no depreciation is required there. So there's clear cut like understood fact. Depreciation aspect is not at all there. Any other question regarding land you can ask me.
No, sir.
Yeah. So if you are using fair value model, no depreciation. Why? Because every year you will be valuing your asset based upon the market conditions. See, if your value of the asset has gone down, you will adjust the asset value to the current value. Am I right? Suppose you were showing the asset at 1 lakh, now it has gone to 80,000. You will be showing at 80 or 1 lakh.
80.
80, of
80,000.
course. So where will we do the depreciation? We are adjusting it every year. But in
Yes.
cost model, we have to constantly use it based upon the historical cost. So we depreciate. Okay. So that's clear, and part of lease also we have discussed. And yeah. Now next part is after the commencement date, the right of use asset should be measured using the cost model in IAS 16 unless it is an investment property or belongs to a class of asset for which revaluation model applies. Yeah, revaluation is nothing but you are revaluing every year. If the lease transfers ownership of the underlying asset at the end of the lease term, that is like it's a long-term lease, or if the cost reflects a purchase option which the lessee is expected to exercise, that is this kind of lease is nothing but finance lease. They don't categorize, but I'm giving you a category for you to understand in a better way. The right of use asset should be depreciated over the useful life of the underlying asset. That means it's a very long term lease. At the end of the lease term, you are having the purchase option also. It's for a 20 to 30 years time period. Which time period? For example, the lease is for 20 to 30 years. So you will be using the asset constantly till the lifetime. So there you would be depreciating or not? Yes. What I'm
Yes, sir.
asking?
We will.
Yes,
Yes,
you would
sir.
depreciate. Yeah. If there is no transfer of ownership and no purchase option, the right of use asset should be depreciated from the commencement date to the earlier of the end of the useful life and the end of lease term. Yeah. So there are two things here. You should be very cautious while doing a question. Basically, leasing question has been introduced very recently. Okay. Previously, they just gave it as a theory. And in Kaplan, sale and leaseback is not at all there. But in BPP, they have mentioned. So these 2 points are very important to understand. If the lease transfers ownership of underlying asset at the end of the lease term, that means there's a purchase option. So right of use asset should be depreciated over the useful life of underlying asset. Useful life. If there is no transfer of ownership and no purchase option, the right of use asset should be depreciated from the commencement date to earlier of the end of the life and the end of lease term. Suppose lease term is for 5 years and end of the life is for 10 years. So which is earlier? 5 years. So it should be depreciated for 5 years, correct? Yes.
Yes, sir.
Yeah, so
Yes, sir.
these points please read once, and then last point is there, then there is a question we'll solve. Done with the chapter. Not much more is there in this. Yeah. And about the subsequent measurement of lease liability after the commencement date, lease commencement date, the carrying amount of the lease liability, that is the value at which you are showing in the books, is increased by interest charges. Of course, interest would be added and on the outstanding liability and reduced by lease payments made. For example, there is a lease of 6 lakhs for a year divided by 12, 50,000 per month. first payment you made immediately. So now the lease liability is on 5,50,000. On this interest would be charged. Suppose interest is 10% and 50,000 is the monthly payment you're doing, it seems, on like five. So this 50,000 will be a combination of interest and principal payment. So 5,50,000, 10%. Do not take this 10%. Let's take it as 1%. So 1%. Let's take it as 2% something. 10,000, 11,000 something. So 50,000 we are taking. 11,000 is the interest part, and the balance 39,000 or so is the principal part. Okay, and in the next payment you would be reducing this 39,000 from 50,000, and then on the balance you would be charging the no, sorry, you would be reducing this 39,000 from this 5,50,000. What is the leftover amount? Please tell me. 5,50,000, na?
Yes,
Hello.
sir.
Yeah,
Yes,
see,
sir.
when you made this payment of 50,000, immediately that much liability has got reduced. You paid it on the first day, not
Yes.
at the end of the year. So 5,50,000 is the leftover amount. From that 39,000 you will be reducing, and then whatever is left over on that you will be charging interest, and then principal will be that's what the interest and principal will be divided in 50,000. Okay, the monthly payments.
Okay.
So like what I'll do is I have explained that is not there in your book. Lease amortization schedule. I have taken the class for CMA USA guys. So I'll be sending you that video so you can understand the amortization schedule, how the lease amortization is happening. Okay. So that will give you a very good idea again. I'll send that video also to you. So watch it, please.
Yes, sir.
Yeah. So let's go ahead and do a question. So as I said you the point here, your 50,000 lease payment, what I was saying is a combination of two things: finance cost, that is interest, and capital cost, that is the depreciation, the assets part, which is like with the passage of time getting depreciated. Okay. So lease expense or lease rental is 50,000, combination of these two. Let's go with the question here. Apportionment of rental payments. Read this question, please.
I don't find that apportionment of rental payment.
Sorry.
I don't find that question, sir. Like the example, apportionment of rental payment.
I'm not able to understand the question.
We are not able to find that question, sir.
Acha, 2
Um,
minutes.
in 2.3, it's allocating the finance charge. Don't find apportionment.
Okay, okay. I think it's a new, yours is a new book. 2 minutes, just wait. Just a second. Just wait, I'm seeing that question. Your book is which year book? Okay, 2020 book, correct?
Yeah.
I'm just taking out 2 minutes. Oh, allocating the finance charge. Then what is this question? Same question only. Okay, this is a different question. Okay, so there are like two questions they have given. Okay, I'm just like sending this to my mail. I'm just opening it.
Yes, sir.
Yeah, yeah. You have the textbook now. Can you send me on this mail ID, please? Hello.
Yes, sir. The example?
No, 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 not an example. You have the textbook now from WhatsApp. When I'm transferring to my this mail ID, my mail ID is full actually.
No, sir, I don't think so.
No, you have the 2020 book now.
So
Okay,
are
do
you
one.
asking us to send a photo of that problem or what?
No, no, no. I have to share the screen and do na, Nikhil. So you send it
Yeah.
this or you send this on my mail ID from your WhatsApp. Immediately it will come. This ID.
Sir, we don't have a soft copy for this material.
I am sending a PDF to Nikhil right now.
Okay.
Okay.
Yeah, yeah. Actually, there are two questions in my book. They have given one question only in your book. 2 minutes. It is almost all like. Okay, or else can you do one thing? Okay, just wait for 2 minutes. It's almost sent. What's the page number? Hello.
215, sir.
What's 215? Okay.
Yeah.
Yeah, yeah. Just got it. Okay, you are saying this one, huh? Like allocating the finance charge. Okay, we'll go with this question, not a problem. Just give a
Yes.
reading to this line company.
Okay, sir.
So line company enters into a 5-year lease of building which has remaining life of 10 years. Lease payments 50,000 per annum payable at the beginning of each year. So mind it, this is beginning of each year. Okay. There will be some instances whereby they'll be giving you lease payments are made at the end of each year. We'll see that case also. Direct cost what they're incurring is this. Incentives they're getting is this. No transfer of asset at the end of the lease and no purchase option. The implicit rate is given to you. Given to you? No. So incremental borrowing rate is given. And the cumulative PV of 4 years time is this. So for 5%, you need not discount for every year. They have given you the factor also. Okay. What is the annuity factor? This. The value of $1 cumulative present value in 5 years time is this. So 4 years time, 5 years time, both are given. At the commencement date, Lion pays initial payment of this, incurs the direct cost and receives the lease incentives. Okay, just read this. We'll solve the question. The question is about allocating the finance charge. It was the same question, but there the data is different. The figures are different, but the question is almost same.
Okay, sir.
Like here we add the direct cost and minus that incentives. Right?
The finance charges. Yeah. Like incentives, you need to subtract.
Subtract. Okay.
Yes. What we need to do is first we will find out the present value of lease liability. So the lease is for how much time? The buildings
For 5
enters
years.
into a 5-year lease, correct?
Yes.
It's for 10 years. But your liability is for 4 years or 5 years.
5 years.
The
5
first
years.
payment is done immediately, na? 50,000.
Yes,
Okay,
sir.
yeah, 4 years.
4 years. The first payment is immediately done. So the rest of the payments are 4 payments now. So present value of those 4 payments and the remaining 4 payments is this. This is your lease liability. And now right of use asset, how will you find out? Initial payment plus the present value of liability, direct cost and incentives. You need to subtract. You get the right of use asset. All right.
Yes,
Yes,
sir.
Now this is right of use asset. This is the liability, and this is what is the current liability portion. The current portion of the liability, what you were liable to pay was 50,000, and 20,000 your cost. That cost 60,000 balance is this, and as a liability is. Now we will measure at the end of year 1 the liability. So opening balance is this, and then you would be paying interest on this amount only. Am I right? Because 50,000 is paid initially at the beginning itself. So the interest on 1,77,500 is at the rate of 5%, and this is the like liability at the end of the year. And what is the current liability portion? 50,000 you are liable to pay. Am I right?
Yes, sir.
Hello.
Yes,
Yeah,
sir.
sir.
Yes, sir.
Yeah, and this is the non-current liability. This is the total liability. So you can just go through this. I'm going for the next point whereby we are going to make the payment at the end of the year. Okay. So 50,000 for 5 years, 2,16,450, like direct cost, incentives, and this is the liability. Okay. Initial payment here we had, there we don't have any initial payment. So this is your right of use asset. This and again your cash, this is your lease liability and direct cost and incentive reduced. This is the total liability. And again, opening balance, interest on this you need to pay. But you know, first year payment you'll be doing at the end of the year, correct? So 50,000 has what actually 10,823. Am I right or wrong? This is included in this payment or not? Please tell me.
Yes, sir.
Yes. So the principal portion is what is the is nothing but the leftover part after deducting 10,823 from 50,000. Okay, that is your principal part, and that again would be subtracted from 2,16,450. See, 2,16,450 at the end of the year you would be making a payment of 50,000. That will have a combination of capital cost and finance cost. Finance cost is 10,823. This removed from this, the capital cost would be removed from this. Okay, so this is your year end balance, and next year interest would be charged on this balance. See this in this book, in your book it is given in a complicated manner. I will send you a separate video whereby I have given the things in tabular representation. Everything is very clearly mentioned, so you will be understanding in a proper and easy manner. But here I am giving you the bifurcation. Na? 2,16,450. Out of that 50,000 payment has been made. This is a combination of two things, finance cost and the principal. So interest, the finance cost is however removed. Okay, that is a separate thing, but the only thing what has to be deducted from the liability is the principal element, so that we are removing, and the leftover liability is 1,77,273. That again interest 5%, again 50,000 has a is a combination of 8864 and the balance amount. That balance amount again removed from this, you will get this. Again interest will be charged on 1,36,137 next year. Okay, but here what is happening is the statement of financial position will show what the non-current liabilities for this period of time, and the current liability is nothing but current liability is what, from 1,77,273 you will remove this balance. Am I right? So that part of the liability is reduced or not? That part of the payment has been made or not?
Yes, sir.
Correct. See,
Yes.
your opening balance, that means your liability was 1,77,273. Now, from that, it has got reduced to 1,36,137 because you made a payment of 41,136. Okay, because 8,864 has gone for interest. Leftover part is the principal payment. This is the current liability. Any doubts? Please ask me.
No, sir.
Okay.
Yes.
Just go for that question, and I have given the format here. The format we have discussed right now. No need to discuss this. Let's do finish this. Aqua company makes up its accounts to 31st December each year. It enters into a lease as a lessee to lease an equipment with the following terms. Inception of lease, term 5 years, 2,000 paid at commencement of lease, followed by 4 payments of 2,000 payable at the start of each subsequent year. Start of each subsequent year. See, not at the end. You should be very cautious. Fair value, present value of future lease payments, they themselves gave this an implicit rate. So right of use asset is what we will calculate. How to calculate right of use asset? You will take the present value of lease liability, correct?
Yes, sir.
An initial payment 2,000. So your right of use asset is 8,075, correct? Yes.
Yes, sir.
So this is your present value of lease liability plus initial payment. We got this. But what is the carrying amount or book value of the asset? The carrying amount is nothing but 8,075 minus depreciation. So this asset would be depreciated for 5 years during the life or leased or what we say earlier, whatever is earlier in useful life and lease term, that will be taken. So let us see in the question what data they give. Did they give the lifetime? it is like useful life is 8 years and lease term is how much? 4 payments now. So it's like which is shorter? Lease term is shorter. 2000
Yes, sir.
inception. Then next 2000 every year beginning. So 5 years. Lease term is for 5 years. So it is asset is depreciated by 1615 per annum, and that we deduct from the assets value, we get the book value. So we'll show this book value in the asset side of balance sheet. Okay, just go through that. I'm going for the next calculation. I'm giving you 2 minutes time.
Okay, sir.
Yeah. Okay. So now we'll come to the end. So this is your lease liability. Interest would be paid on this. Your present value of the liability is this now, 6075, and you will be paying interest on that. And you got the present value of your liability from the question itself. You need not do any hard work on this.
Yeah.
So this is what is your ending balance, and the first installment is 2000 has to be paid now. They paid it in advance. First, actually initial payment has been done. After doing all these adjustments, only the lease liability is this. Next year they will be making advance payment of 2000, correct?
Yes, sir.
Installment. And then liability due in more than 1 year is this, like next year liability again. The same thing will be continuing. Interest, you will be adding up interest. See, 2000 will be a combination of two things, the interest and the principal payment. Principal payment will be reduced from the right of use asset value, or whatever the liability is. This is your liability now. So principal payment will be removed from this, and after removing the principal payment, the leftover part, whatever is there, on that you will be again calculating your interest. Okay, and then again you'll be adjusting with this next year's installment payment of 2000. That means 2000 will be a combination of finance cost, the interest, and the capital cost. Okay.
Yes, sir.
So this was for the first year. This is a liability, interest taken. Add up that interest to this. Okay. So like, because your this will be increasing your amount, but again 2000 you are paying. So in that 2000, this 729 is already there. So that will be deducted with the principal element. 729 will be going in the P&L account, finance cost. So 6075. Just a second, I'm doing some calculation. This was at the beginning. This is first year's end, second year's beginning. Okay, so 6075. In the first year, what they have done is 2000, they made the payment at the inception. Okay, so that payment, what they have done in the inception, that payment is not counted now. So the liability which was there from the beginning of the year was 6075. Please tell me yes or no.
Yes, sir.
See, 2000 you paid initially now while making the lease contract or lease agreement. That payment has already been done. Now the leftover liability payment is 6075. On that you will be paying interest in the first year. So now your liability at the end of the year is 6084. I'll write it here. 2000 paid on 1st Jan. 6075 is your outstanding amount. On that you will be paying interest. Interest is 729. First year is done. Now comes the second year. In second year also you are making the installment in advance out of 6084. Okay,
Yeah.
that installment is a combination of what?
Interest and also the
Yeah,
principal.
but here you are making installment in the beginning itself. So so your leftover liability is how much now? 4084, correct?
Yes, sir.
See this liability which is there, it is the first year's liability. For next year also this is the liability, but you're settling it with 2000 payment.
Yes, sir.
And now then so immediately your liability is 4084. Now on this you will be charging interest. What is the interest? I will tell you, I'll show you this. First year 6075. 2000 paid initially during the inception of lease. So that is gone. No interest in this. Why? Because interest you will be only like paying the interest payments if the first year ends. Okay. So for the first year, the interest will be on this liability, outstanding liability. How much is that? 729. Now your total liability is how much? 6804. Now next year, what is happening in the beginning? 2000 immediately you are paying.
Yeah.
So 2000 when you are paying immediately, interest element will be charged for the entire year, na?
Yes, sir.
So this 2000, which actually should be a combination of interest and principal. Here in this case, the interest element we cannot take in 2000. This is directly reducing your liability. Correct or wrong?
Yes, sir.
See, in 2000, the lease rental what you're paying is a combination of interest and capital cost. But in this question, it's a special case. In this, payments are made at the beginning of the year itself, but interest will be accruing in the like during the year time. That means this is 6084. This year ends, next year starts. So this the interest for the next year will be paid in December month. Am I right? For the entire year.
Yes, sir.
So what we will be doing is this 2000 will be removing from this, and immediately our liability is 4804. On that will be charging interest and adding it to adding that to 4804. Again you'll be getting this year's liability. Again next year 2000 will be immediately reduced and interest will be added. Like that the things will be going on. But
Yes.
if, for example, these payments are made at the end of the year, then what will happen? Then you will be removed. Then 6075, for example, 729, for example, 2000 at the end of the year. So now what is happening? This 2000 will be a combination of interest and capital cost. Okay. From which only capital cost is what will be removed from this and interest will be added. Are you understanding?
Yes, sir.
What are you understanding?
For this, the capital cost will be added.
6075 is there now. From that, if I remove 2000, okay. So like 2000 initially I have removed. Okay, in this they have done all the adjustments. So that is not going this question has a different kind of mechanism given because 2000 is paid initially. So that already has reduced the liability. Now the outstanding liability is 6075. On that interest has to be paid 729. Now assume 6804 is your liability of this current year. Next year, the payments are made at the end of the year. The payments are made 2000 at the end of the year. So that in that case, what would happen is in the year end, you will be subtracting 2000 from this.
Yes, sir.
But that 2000, in that 2000, it will be a combination of interest and capital cost.
Yes, sir.
Okay. So only what element would be removed from this principle from the 6804? Only
Capital.
Capital cost. So interest cost would be added to this. So it is better if we write 6804 plus the interest less the payment, the lease payment, suppose 2000. So that will reduce that will adjust it in such a manner that whatever you will be getting will be the liability at the end of the year, outstanding liability. Okay.
Yes, sir.
Yeah. So done with this, and disclosure requirement for leases is what you should disclose what depreciation charge you are levying on this right of use asset. What is your interest expense on lease liability, expenses relating to short term and low value leases, sale and lease back. If you are doing, then you should give details about that. Carrying amount of that right of use asset is what at the end of the year, and any kind of addition to right of use asset during the year if you are making, you should disclose that. Okay.
Yes, sir.
So sale and lease back, I'm sending the video of this. I have a full-fledged explained video that would, if I send that, if you do that today, this lease would be done for you. Okay.
Okay, sir.
And in the coming next week, we will do income taxes and financial instruments. 2 chapters. Where is that?
Yes, sir.
Okay.
This and taxation. And I will be sending you that lease amortization schedule video also, which I have given in a tabular representation form. You go through that, it will be very easy for you to understand. Okay.
Okay, sir.
Yeah.
Okay.
So done with this chapter. Next week, I'm going to conduct a test on ratios for you. So be prepared for that test. Okay. Sure. Anything else you want to ask?
No, sir. We'll do this thing, and if we have any doubts, we'll reach out to you, sir.
Yeah, you can bring it to me, to my notice. And also I have given you Kaplan text. Better, like after finishing this chapter, you do questions from your Kaplan text also. Sale and leaseback is not given in your Kaplan text as far as what I know. So do that Kaplan text thoroughly, all the questions, and finish this chapter. And be prepared with the ratios test next week. Okay.
Okay,
Thank you.
sir. Yes.
Yeah.
Thank you.
Thank you. Thank you, all of you.